There are millions of strategies out there that you could be looking at if you're an option seller, but one strategy stands above the rest as probably the best thing you could be doing if you have a healthy appetite for risk and are just trying to make the highest dollar return possible. This strategy is selling options around earnings events. And in today's video, I'm going to explain to you exactly how this strategy works, how to find opportunities and structure trades for this strategy, and I'll even show you a case study of how my friend Jay made literally $225,000, a 90% return on his portfolio in just 2 years. If you're new here, my name is Sean Ryan. I'm the founder of Predicting Alpha, and I'm delighted to be able to take you through this video. If you're an option seller who's just looking to run boring strategies that actually make money, click the link in the description of this video and take a free trial with us. I promise you, you're going to love what you find. The idea behind the earnings strategy is actually very simple. It's just that around earnings events, we tend to see a risk premium. Implied volatility, or option prices, tend to overstate the realized volatility that happens because of the event itself. Or the amount the stock moves on earnings tends to be less than what is baked into the prices of options. Now, whenever we're looking at a strategy, we want to ask ourselves, why should this be the case? Why does it make sense logically that there would be a risk premium or that options would be expensive around this earnings event, for example? Well, in the case of earnings, it's actually very obvious. Earnings drives something like 30 to 70% of how much a stock is going to move in a given year. So it makes sense that people want to hedge their equity positions going into earnings events or speculate on which direction a stock is going to go. Basically, it makes sense that people want to be buying options going into these earnings events. Now, on the flip side, if we know that earnings events causes stocks to move in a very volatile manner, it makes sense that there would be a reduced supply of people willing to sell options around earnings. Think about the environment this creates around earnings events. You have an increased demand in people looking to buy options around the event, and a decreased supply of people willing to actually provide that liquidity and sell those options. And if you studied economics, you would know what happens when supply decreases and demand increases, prices go up. And so it makes sense that we see that option prices on average overstate how much movement there's going to be in the underlying ticker. What does that mean? It means we can actually make money selling options around earnings. So that's the core idea behind why this strategy actually makes money. And if you understand that fundamental principle, it allows you to really stick through some of the other stuff we're going to talk about later in this video related to how much variance you can experience in this strategy. This is definitely not a hands-off, slow and steady strategy. There's a pretty high variance in your P&L that will occur, but the expected value or your long-term expected return from doing something like this is really high. And the reason is because it's going to be volatile. You're going to need to take lots of trades. There's a lot of execution you'll need to learn. But once you do, the sky's the limit. All right, so the rest of this video is going to be broken down into 3 sections. The first one is going to be, I'm going to teach you how to find trades for this strategy. The second section will be how to manage and execute trades for this strategy. And the third will be me sharing a case study from my friend Jay, who made 225 grand trading earnings in the last 2 years, 1,200 or so trades, a 90% return on his portfolio, and he was kind enough to share a fully documented trade journal with us. So stay tuned for that treat at the end. It's really going to paint the full picture of everything we talk about. It's going to be really cool. All right, let's hop over to the computer and I'll talk to you about how we're going to find some trades. So remember this, the core idea of trading earnings is that you want to be selling options before the earnings event and then closing out your position after the earnings event occurs. So there's really a couple things that we need to do. The first is we need to figure out what companies have earnings that are tradable today. Meaning if today's Monday, what companies would have earnings Monday after market close or Tuesday before market open. The reason that this is so important is because we want to isolate the earnings event. We want to be trading into the position right before the event and then exiting the position right after the event. So to do this, we just come over to the Predicting Alpha scanner. And obviously today is Friday, so there's no earnings today. But typically we just have a scan that you'd click here, the earnings premium scan. And this would literally just show you all the companies that have earnings today. But to give you an example, we use this earnings look ahead tab. So this is all the earnings that are happening in the next month. And then for all of these, you can see, what day the earnings is, how much liquidity is there, and what the return on selling straddles has been over the last 4 years of earnings. Now, always remember this when you're trading earnings. The fundamental reason why this strategy makes money is because the earnings events themselves have a risk premium. So that's why the starting point for this strategy, when we pull up a list of tickers that we're going to be trading for today, is that we actually want to be taking all the trades. All of these companies have an earnings event. We know that's what's driving the premium, so we want to be taking as many trades as possible. But the reality is that most of us will not be able to take maybe 50 earnings trades in a day, right? We don't have these $5 million accounts, $10 million accounts that we can be doing this with. So we need to apply some sort of filtering to our trade process to really find the ones that we want to be taking. So once we've generated a list of trades that we want to take, the next step is to make selections from that list about the ones that we believe have the highest expected value and the ones that we are going to actually be placing trades on today. So coming back to the terminal here, the way that I look at which trades I'll be taking today is based on 3 primary factors. Now, other members in the community use a different set of factors, a different set of filtering, but the ones that I use are basically these. The first is the average option volume. So I want to be trading things that are pretty liquid. And by pretty liquid, I'm talking about things that have at least, let's say, 1,000 daily average contracts traded. So on this list here, for our little look ahead window, at least on these first few, these all actually look like reasonable candidates in terms of option volume. So that's the first thing that I would be considering. Now, the second thing that I look at is the earnings short straddle return. And what I really want to see here is that the earnings short straddle return has been positive. What does it mean when this is positive? It means that over the last 4 years of earnings for this ticker, the return from selling a straddle over each of the events has been positive. How positive it's been, I don't mind as much. Some people will say I only want to take the most positive ones, things with over 100% return, for example. But just knowing that on average it's actually made money just indicates to me that there should be a risk premium here. Even though it's small sample size, only 4 years, it's another layer of filtering that I include because, hey, look, I'm not able to take all these trades anyways. I might as well take the ones that have at least recently exhibited this risk premium that I'm trying to capture. So I'll take the things such as, HUN or RAG. RAG is maybe too small of a stock at $3, but ANET, AXSM, these are all looking good, right? Baidu would be one that would be on the list for this upcoming earnings. Now, obviously, there's still a fair number of tickers that meet this, and let's say I need to continue filtering down. The next thing that I use is the implied versus average move, right? So IEM stands for implied earnings move. We basically take the straddle price and we extract the implied earnings move from it. So how much is the market saying the stock will move up or down? And then the average move is how much has it actually moved on average the day after earnings. What I am looking for here is tickers where the implied earnings move is greater than the average earnings move. We want to see a spread between the two. It basically means that how much the stock moves on average is less than what's being implied to happen for the upcoming event. So things that look really good, for example, right here at HUN, it's a pretty big spread, right? 1.7% or so, right? This is another big one here on ANET. Looking at Bumble, for example, this would maybe be one that we wouldn't take since it's basically the same, even though it's got the positive short straddle return. So if I had to filter out, maybe Bumble gets chopped from the list here, but we keep things like, Baidu and ANET. And this is how I go about filtering things, right? Primarily, I spend almost all my time for earnings on this scanner here, finding trades that look good, that make sense for me to be taking. And that's primarily what I'm doing when I'm trying to create a list of trades for this earnings strategy. I'm using the scanner. I'm looking at which tickers meet my criteria. These 3 things I look at: the average option volume, the return on short straddle, and the difference between the implied and average earnings moves. But once I've got that list together, there's one more little bit of analysis that I do before I put together my trades for the day. And that is that I dive into each one individually and take a look at the backtest itself to see what the shape of it looks like, so I can see if it matches what a typical short straddle return should in fact look like. Let me show you what I mean. So let's take a look here at Baidu, for example. If I come in here, clicking on that brings me into this tab for Baidu, where I can see all the key data that I need. I can see an individual event breakdown of how much things moved. I can see the backtest trade by trade over the last 4 years. I can see the implied earnings move, how high that is compared to usual, how often the average move is lower than implied, how often the jump is lower than implied. All of this key data is stuff that really matters when it comes to running this strategy. But today, in this video in particular, we are going to focus on one thing in particular, which is the shape of this hedged short straddle backtest. Now, something that I always want to remind you about is that selling options is one of these strategies where most of the time we should be seeing small winners, and then occasionally we should be seeing big losers. That is the nature of being short options. You can think of it like an insurance strategy where, if you're insuring cars, most of the time cars don't crash. So you collect your little bit of premium, life's good. And then once in a while, cars do crash and you have to pay out a larger sum to do a repair, right? That is the nature of what selling options is like. Most of the time, we should be collecting our premium, and then once in a while, we should be paying out large sums. So coming back over here, if we take a look at the shape of this backtest, does this reflect what we expect to see? Well, I would argue that it does, right? Subjectively, of course, looking at the shape of this, we can see that most of the time there's a small profit to be made selling options around buy-do earnings. And then there was a period where there was a few losers that happened that dragged down the P&L, right? We originally went up about 100% return. It brought us back down to zero. And then it's been a steady climb ever since. And in the last few years, we've seen a profitable trade on buy-do earnings. And, this doesn't mean that in the future, we're not going to see losing trades. It just means that the probabilities of seeing outsized moves matches what we expect to see for a short volatility strategy. Most of the time, we would expect to have a small winner, and then there is the occasional risk of a larger loser. Now, this brings me to something really important that I want to talk to you about, which is a question that I'm sure is on your mind. Hey, Sean, if there's a big loser, I'm going to take a huge drawdown. Why would this strategy make money? If I'm just selling options around an earnings event, what if there's a big move tomorrow? Aren't I going to lose? Well, if we were only looking at trading one earnings event, you would be absolutely correct. If all earnings events were correlated with each other, you would also be correct. But this is where the beauty of running this earnings strategy really shows itself. Earnings events are inherently uncorrelated from each other. And what this means is that instead of needing to put all of our capital into just one trade, we are able to take hundreds of trades every single earnings season, allowing us to spread our risk in really small bets across lots and lots of trades so that the impact from any single event is not too large to pull our portfolio into a significant drawdown. And instead, we're able to basically extract the average risk premium from across all of these positions. Think about how powerful that is. This is one of the few strategies where there is enough trading opportunities that we as retail traders can get the massive amount of diversification needed to get a smoother P&L than we would have by just having to trade one ticker individually. As a little bonus, something that you'll see later on in that case study we do, it's actually got a very low correlation to the market too. So if you're typically selling options on ETFs, for example, which is one of the other strategies we do in PA, this is actually a really good complement to that because guess what? It doesn't have that correlation to the market. It actually acts as diversification from that core strategy, something you'll see during that case study. So with that said, we've basically reached the end of the analysis that I do when I'm trying to pick which tickers I'm going to trade. Believe it or not, it's not that in depth. And that's because, bringing you back to the first thing I said, the edge itself is in the earnings event. If the earnings event wasn't happening, we wouldn't be placing a trade at all. And the thing driving the risk premium is the fact the event exists. All of this analysis that we're doing is to, one, find the tickers that have an earnings event that's tradable for us today. And two, since we can't trade all of them in most cases, we need to find a way to whittle down that list to the things that look the most attractive to us. I shared with you the way that I do it, but you have access to a ton of data in the Predicting Alpha platform and a community of people who do all sorts of their own analysis, so I'm sure you'll find your own way to whittle down that list. If you're not a PA member and you don't plan on becoming one, the way that I would recommend it is just based on liquidity. It's the easiest, simplest way to do it. Just look up the daily average option volume for each of the tickers that you're trading. Trade the ones that have the highest liquidity so that you're not losing too much money on your bid-ask spread, right? Having to execute these positions. And that is how to manage and execute these trades. Earnings is actually a game of trade execution. These are positions that we're going to enter into before market close. And then early in the morning the next day, right after market open, we're going to be fighting to get out of these trades. But at the time when we're fighting to get out of these trades, the stock has just seen a significant move, meaning the market is repricing, the bid-ask spreads are going to be wide. We are going to have to fight for a good fill. And not only that, there will be times that we have to be really patient and wait for that fill. And it can be a very tricky time for traders when you maybe have 15 or 20 of these positions on even. So I want to talk to you about trade management, how to structure them, all that stuff here, because hey, that is literally more than half the battle, I would say, when it comes to this strategy. So now when it comes to what structure we use to run this strategy, there's basically two that we use. Number one is a short at the money straddle on the closest expiration. And number two is a short strangle around delta 10 to delta 15 that is also on the closest expiration. Now, the reason we trade these structures is because we are trying to sell the implied move. Selling the straddle is the cleanest way to get exposure to the implied move. So most of the time, that's what I'm seeing people doing. If you sell the at the money straddle and it expires in like a day or two, if it's implying a 5% move and the stock moves 3%, you should expect with decent execution to make a profit on that position. And if the stock moves more than 5%, you should expect to lose money on the trade. That is literally like selling the implied move. Now, the reason people will often sell the strangle is because in a lot of these cases around earnings, there's an extra bit of premium in selling the wings. We see it across a lot of option strategies where there's actually embedded premium in the wings because when you're out of the money, there's that skew, you get a little bit of that, and that can increase your returns. And when we actually look at the case study, you'll see that selling the wings actually does make a bit more money. But the reason why I say people do one of the two is, first of all, you get much better feedback on your trade when you're doing the at the money straddle because when you're doing the wings, there'll be times where the implied move will actually be breached. Like the stock will move more than implied, but you'll still make money. And so you're not getting that feedback about how the strategy is performing in this quarter. But the second reason is it's a lot more liquid when you're trading at the money. So you can get in and out of your trades sooner and you don't end up having to hold trades well beyond earnings to get out or just getting, bad fills and leaving a lot of money on the table. And that's a lot of what you'll face when you're trading the wings. If you choose to do the strangles, you will have a much higher win rate, but your losses will be much more significant relative to how much premium you collect. And you're also going to have a little more trouble with your fills because there's just less liquidity out in the wings. Now, if you want to have a hedge, what people will sometimes do is actually buy some wings for themselves. So they'll sell the at the money straddle and then they'll go really, really far out and buy wings for like a penny. And the reason people do this is because once in a blue moon, there will be a massive move, right? Something that is just like an incredibly sized move. You'll see it in the case study as well. There's a couple examples of that. And buying these wings for a penny or two can cap the loss in the situations where these massive moves happen. Remember, we're selling vol around earnings events. If it's going to happen, it's going to be during one of these times. Hence, there's a premium. Now, if you choose to buy wings, a word of wisdom would be to not try and structure your trades to have a good risk reward. If you've watched any of my other strategy videos, like our ETF strategy, for example, I say the exact same thing. The point of buying protection, of having a hedge, is not to give you a good risk reward. It's to hedge away the risk of ruin, the risk of disaster. And by thinking about things this way, it allows you to not give up your edge. Remember, we're getting paid for holding risk. We have to continue to hold that risk if we're going to make money. And rather, it allows us to simply pay a little bit of our edge away to get rid of the worst case scenarios. So there you have it. That's basically the structure that I use for this strategy, the couple variations. And as for trade management, I'm entering the trades 5 minutes before market close on the day before earnings, and then earnings happens, and in the morning, I'm typically getting out around 15 minutes after market open. The reason I'm waiting 15 minutes, maybe sometimes even 30 minutes, is because even though the market's open now and technically earnings is over, we need the market to reprice a little bit and get a sense of what fair value for options are so that the spreads come in. You'll see it yourself when you start running this strategy, that in the morning, the bid-ask spreads are going to be very wide. And by having a little bit of patience, you'll see those spreads start to come in. And even though the stock could move after earnings and things can happen, the compensation for that is the spreads coming in, and it far outweighs the added risks of holding for a little bit longer. This is one of those things where even though, the earnings event is over, it's a technical skill you need to understand, which is trade execution. You have to be able to get fills on your trades. Otherwise, you're just going to get eaten alive by the market maker. Once I'm out of the trades, I pretty much stop running the strategy for the whole day, and I wait until 30 minutes before market close, where at that point, I'll go back into the PA terminal. I'll look at the scanner for the day and say, what's got earnings? I'll do my little bit of filtering, put together my list, and in the last 5 or 10 minutes, I place my trades. That's it. It's actually a very structured and systematic strategy once you get used to it. Each earnings season, I'm placing a couple hundred trades, and on average, you'll have a pretty good return. Now, there will be quarters where there is a drawdown. Remember, there's no free money. Somebody is giving you money for a reason with this strategy. You're getting paid because you're holding risk, and that risk does materialize. So to show you a bit about that risk materializing, but also the reward that comes with holding that risk, let's hop back onto the computer, and I'll show you the case study from Jay, where he made 225 grand, 90% return on his account, and all the ups and downs that came with getting to that result. All right, so I did write an entire article about this where I go over all the details. I'm not going to bore you too much with this right now, but I will link it in the description if you want to read it. And rather, we'll just come over to the document itself here and talk to you a little bit more about this. All right, so this is what the cumulative return looked like. It started back in the end of 2022, and we ran it until the end of 2024, so about 2 years here. And the first thing that I want to show you is, wow, this is a beautiful line. I wish my P&L looked like this. Jay, you did an amazing job. You are an absolute legend. This is super cool. He started with about 250 grand. He ended with almost 500 grand in his account 2 years later. 90% return, made about 0.37% return per trade. I think it was about 1,000 trades, 1,200 trades. I think it was, oh, I have the number here. It was 1,380 trades placed with 1,100 winners. Crazy results, man. Crazy results. This is really cool. And talking about what short volatility strategies look like, you can see it here. The average winner in terms of dollars was about $800. The average loser was about $3,000. So much bigger losers than winners, but much more frequent winners than losers. And then you can see here the biggest winner was about 10 grand and the biggest loser was a little over 30 grand. Now, in terms of what structures Jay used, about 29% of the time he was using straddles, so that at the money strikes that I was telling you about, and about 63% of the time he was using strangles, those wider strikes that I was telling you about. On average, he was placing about 6 trades a day, so he did a decent amount of filtering, but he did have one day where he placed almost 30 trades. So Jay was, packing on a lot of trades at some point during this process. And on average, he was collecting about $1,500 in premium per position. So he had a decent amount of size on, because if you're doing $1,500 on a 250K account with strangles, like you're going to have some variance there for sure, right? Like there's going to be some pretty big swings in the P&L. But as you can see here, obviously the expected value is very, very high. So now that I've talked about how glorious this return is, I need to point out the caveats, right? The risks that come with this strategy. There was a point in time where Jay had made a $200,000 profit on this. And then in what looks to me like 1 quarter, he went from 200K in profit to just about 170K in profit. Right? He experienced more than a 10%, a 15% drawdown in just this moment right here. There's other times where this happened as well, right? Looking back, we can see at the start, right at the beginning, Jay went through a period where immediately he took a drawdown of what looks to me like maybe 15% of his account. Immediately, within 2 months. I know most of you are going to look at that and go, hey, I don't know about this strategy, 15% drawdown in 2 months. You got to remember, there's a reason why you're getting paid. There are going to be quarters where there is going to be a big drawdown. At the time of me making this video, that is actually happening right now. The start of Q1 has been really rough for earnings. Most of the people trading earnings right now have experienced a bit of a drawdown. But looking at this and understanding the backtests around earnings and stuff, it's nothing out of the ordinary. It's literally a part of the strategy. It is the risk premium itself. And if I were able to really share one thing with you, it would be that every strategy you run is not free money. There is nobody just giving you money for free. That is why drawdowns happen. That is why, assuming you're doing something with positive expectancy, the line doesn't just go up and to the right. And that's exactly why we see here, right? We see 30% drawdowns. We see this 15% here at the start. But we also see that when you're able to take a lot of trades that each have a small amount of edge, you can generate a really, really fantastic return. Now, just to show you that this is not BS, and also you can access this spreadsheet yourself in the document here. We have it linked at the top. Right here. You can see it here. You can click us. Here's a list of all the trades with the P&L for each one. You can literally come in here, do your own analysis on it. It's all available for you here so that you can do your own thing and do your own research for earnings. We give it to everyone for free. Now, coming back over here, we'll look at one more thing quickly, which is just, I wanted to show you this. This is a comparison of the winning and losing trades, right? Reflecting that idea that most of the time we should have small winners, but then that left tail, that losing tail should be longer than the right tail, right? We should have that really deep losses that could happen. We expect to see that. That's what these strategies look like. And that's exactly what we see here, right? If we take a look at this graph, we can see that the biggest bar here with the highest frequency is a small winning trade and a little bit bigger of a winning trade and a little bit bigger of a winning trade, but all small wins relative. And then the tail on the left side here, you can see it goes way out to this like minus 30,000 mark, way longer than we see on the right side here. You can just tell from where the tallest bars are skewed to the right here that this left tail definitely goes a lot longer. And that's what we expect to see. All right, so I know this has been a long video, but I'm really excited about this strategy. I think it's a great thing that's available for retail traders. And if you're a serious option seller who's already got a pretty good portfolio going, this is something that you should consider adding to the way that you run your book. It's a diversification from the typical short volatility on the market stuff. You're trading events in particular, so there's lots to trade, lots of diversification available. There's a logical reason why a strategy like this should generate profitable returns. And there's enough evidence from people running this for a long time to know that, hey, this seems to be a viable way for us to generate returns for ourselves. The last thing I'll say is this is one of those strategies where most people don't have the stomach for it, which is why it doesn't get overcrowded most of the time. And that's part of why I'm grateful for the high variance in this strategy, because it protects the really high rewards that are available for PA members and myself to participate in. All right, everyone. That is really all I've got for this video. I know this strategy is a little complicated. I hope I did it justice in this video. If you have questions about it, leave them in the comment section below. I would be happy to talk to you about selling vol around earnings. And of course, if you are a serious option seller, we have 1,000 spots available. That is it. We are a closed private community for option sellers who are trying to run systematic strategies. If that's you, I would love to see you there. You can join for free. Click the link in the description, and I'll talk to you then. All right, everyone. Take care.